This presentation will guide you through 3 proven strategies to make smart trades and develop your skills as a successful trader. Good day, everyone, and welcome to day 2 of our 7 days intensive Forex training class. My name is Anthony Phillips Njoku, the founder of 10x Digital Lane, where everyone who has a knowledge gap in digital trading can get the right knowledge, get the right guidance, get the right system to enable them to trade the financial market profitably and achieve success. So today is day 2, and we'll be talking about mastering the art of smart trading. Mastering the art of smart trading. If this is your first time, smash the like button, subscribe, and comment below whatever you learned at the end, because it's packed with a lot of information. So the world of trading can seem intimidating, but with the right knowledge and strategy, you can navigate the market with confidence. This presentation will guide you through 3 proven strategies to make smart trades and develop your skills as a successful trader. Okay, so get your notebook, get your pen, and take down important notes. So we're talking about unveiling technical analysis. First of all, we will talk about chart patterns. Technical analysis involves using charts, indicators, and price action to identify patterns and trends in the market. Mastering chart patterns like head and shoulder, double top, and triangles can help predict future price movements. Then about technical indicators. Technical indicators are mathematical calculations based on historical price data. They can help traders identify overbought or oversold conditions, potential trend reversals, and area of support and resistance. Common indicators include moving averages, MACD, and RSI. Don't worry, you're going to see an example of all this. So here are a few examples of Forex chart patterns and technical indicator. The first one you see there is the head and shoulder. The first one you see is the head and shoulder. And this head and shoulder helps us to identify a trend reversal. Head and shoulder helps us to identify a trend reversal. Then we have the double top pattern, which is also a very important pattern that helps us to identify an area of support or resistance. It's an important pattern that helps us to identify an area of support and resistance. Okay, so this is the double top pattern. This is the head and shoulder pattern. So head and shoulder is formed at a area of resistance, identifying the trend of sell. It is a technical pattern. Double top as well is identified as an area of resistance, identifying a sell when the next line is broken. It is a sell pattern. We also have inverted head and shoulder, which is this way. Okay, sorry, this is a double bottom, which is a bullish pattern. Then we have inverted head and shoulder. Inverted head and shoulder, which is a bullish pattern, identifying a buy. So all these, you need to be aware of them. All these, you need to be aware of them to be able to trade the market profitably. Okay? So the next is the bullish flag pattern. The bullish flag pattern. The bullish flag pattern is a buy signal, just like it sounds, bullish flag. It is identifying the continuation of a bullish trend, the bullish flag. The bullish flag has a flagpole, then a corrective structure over here, which forms the flag itself. Then the breakout is your entry. From here is your entry to buy. Then the double top is a reversal pattern, which has a resistance. When the market comes to a supply, it touches the first time, comes back to it, touches it the second time, like we saw on USDJPY last week, and then the break, the continue of the sell. Then over here is the head and shoulder pattern, which is a total reversal pattern, which forms the first high, which is low, then forms a peak, which is the head, then forms the right shoulder. The entry is at the break of this neckline. Over here is the entry for your sell. This is where you get your sell. Then over here is RSI indicator. This RSI indicator, whenever the candle chart is above it, is a mathematical indicator. Whenever the candle chart is above it, it is a signal for buys. Whenever candle chart breaks below it, it is a signal for sell when the RSI goes above the candle chart, which is now an oversold indicator. Okay, at that point. So with that said, let's talk about understanding fundamental analysis, the driving forces of the market. News impact is very, very important. Take technical analysis as the body or structure of the market, and take fundamental analysis as the blood that makes this body to operate functional very well. Okay. So fundamental analysis focuses on the economic and financial factors that drive market movements. News events like interest rates changes, economic report, and company earnings releases can significantly impact asset prices. That's for news impact. Then economic indicators provide insights into the health of a country's economy. On a daily basis, there are economic indicators that show you the health of a country currency, like dollar, euro, pounds, JPY, NZD, AUD, CHF. There are indicators that will show you the strength of every single currency at every single time. You need to be aware of it. It's very important. Okay, so some indicators are like the GDP growth, inflation rates. When inflation rate is high, it makes a country's currency to be strong. Investors will want to buy it. And unemployment rate data, when unemployment rate is high, it makes a country currency to be weak. Investors will sell the currency. This can influence market sentiment and affect investment decisions. Understanding these indicators is crucial for informed trading. Very, very crucial. But note, this market is highly manipulated. One indicator can be pointing for strength, why the market maker will have plans for weakness. Okay, that's why we always say apply proper risk management. Okay, good. So we're talking about the top 3 trading strategies for beginners. One, we have scalping, and scalping involves making many trades throughout the day. Okay, aiming for small profits on quick price movements. It requires high speed and accuracy. Day trading focuses on holding trades for a single day, attempting to perform inter-day price fluctuations. It demands continuous market monitoring. So here in our academy, 10x Digital Lane, we teach you a day trading strategy. We are day traders. I'm not a scalper. I'm a day trader. And the strategy we're going to teach you is a day trading strategy. You hold a trade for a day, maximum 2 to 3 days. Okay. So for swing trading, it involves holding trades for a few days or weeks, capitalizing on intermediate term price swings. It relies on identifying market trends. Very, very crucial. Okay. So with that in mind, let's talk about risk management and capital protection. This is one of the most important strategies. Aside studying head and shoulder indicators, scalping, intraday, if you don't study risk management and capital protection, you're doomed. Because there is a statistics that 90% of traders lose 100% of their capital in 6 months. So you need to go against that statistics. You need to go against that statistics. What makes a lot of traders quit trading is because they don't have capital anymore. But if you can see that this is a journey and not a destination, you'll be able to understand that the financial market has to do with you what? Applying proper risk management. So understanding risk management is very crucial. Effective risk management is crucial for long-term success in trading. It involves strategies to protect your capital and maximize your profit potential. Key components include stop loss orders. This automatically closes a trade when the price reaches a predetermined level. Limiting potential losses. For example, with $5,000 capital and a 1% risk per trade, your stop loss would be $50. Just like you can see over here, this is the entry, this is the stop loss. If this market went up like this, went up, the candle went up, and then come over here and hit this level, you will lose what? $50. That is your stop loss to stop losing. Then take profit orders. This automatically closes a trade when the price reaches a predetermined level, securing profits with a 1:3 risk to reward ratio, which means that if you're risking one, $50, you're aiming to make 3. That is risk to reward ratio. A $50 stop loss would have a $150 take profit target. So the market was moving up. We've got our entry from here, and the market is now going down. Once the market gets to this point, take profit, we make $150. That's what it means. So risk to reward ratio. This is the ratio of potential loss to potential profit. A 1:3 ratio means that for every $1 risk, you aim for $3 in profit. This helps manage risk and increase the probability of profitability over time. Then the next thing you need to learn is scaling your account. Scaling your account. To grow a $5,000 account to $1 million require consistent profitability and strategic account management. A 1:3 risk to reward ratio and a disciplined approach, including careful position sizing. And I'll be teaching you guys about the careful position sizing during our practical class on my FX book, are essential to minimize risk and compound gains. For example, a 1% risk trade on a $5,000 is $50. With a 1:3 risk to reward ratio, a $50 stop loss should aim for a $150 take profit. This approach applied consistently helps compound growth. It also necessitates a rigorous adherence to risk management principle. So over here, this is your account. Let's say you start with the $5,000 account. So with compound interest, applying 1:3. There are sometimes you have losses, but overall, due to probability, based on your strategy, there are strategies that have 60% win rates. There are strategies that have 80% win rates. There are strategies that have 30% win rate. Once your strategy has a win rate and you apply proper risk to reward ratios, applying the discipline to it. This is what's going to be your account. There will be this compound curve. There will be this compound curve. So once you have this in mind, that trading is a probability based on your strategy, and also your risk to reward, it works hand in hand with you. That's why before you place a trade, you need to tell yourself you're ready to lose this certain amount of money. And in return, this is the amount of money you're going to make, nothing less but more. Do you understand? But once you choose to make less than the actual target, you're becoming a scalper, taking what? Little profit within swings. Okay? So, with that in mind, we're still going to practice every single point here. Psychology of a successful trader, very important. Before a trade, like I was saying, before a trade, a successful trader approaches each trade with a well-defined plan. They analyze market conditions, identify potential opportunities, and set clear entry and exit points. Emotions are managed through discipline and pre-trade planning. Emotions are managed through discipline and pre-trade planning, reducing impulsive decision-making. During a trade, while in a trade, maintaining discipline is crucial. They stick to the predetermined plan, avoiding emotional reactions to market fluctuations. They track their progress and adjust their approach as needed, but always within the parameters of their risk management strategy. A successful trader calmly assesses their position rather than panicking. Loss or profit. A successful trader treats both wins and losses objectively. They avoid letting emotions drive trading decisions, acknowledging each outcome as a data point in their overall strategy. Post-trade analysis is performed to assess what worked and what didn't, and what could be improved. So a lot of traders have this wrong approach. They are driven by fear of the market hitting their stop loss, or they are driven by greed, having a predetermined target of $150, but they want to go for $200. And finally, hope, not analyzing the market or getting a certain fact that stands in for the reason why you place the trade. The trader diverts from their plan. Stop losses may be ignored or moved, and take profits may be missed. Emotional trading often leads to increased risk and inconsistent results, and can result in large losses of your trading capital. So the right approach I'm teaching you guys today, and which I want us to practice from today, the market is opening in few hours. The trader adheres to their trading plan, managing their emotions through a rational, data-driven approach. They stay disciplined, focusing on their risk management strategy. A consistent, disciplined approach over the long term is key to success. Thanks so much for watching to this point. Don't forget to smash the like button, share, and comment below what you liked. As well, share your questions in the comment section. I'll try to as well reply. And do have a profitable trading career.